Good afternoon, well, morning for some of you. Welcome to our LTCI Sales Bites discussion. This is Brittany Button, your long-term care insurance specialist for Art Jetter and Company. And today we have Larry Moore, Regional Marketing Director of Lincoln Financial Group, joining us. Now, as promised, we are going to keep these sessions short and simple for y'all. Today, we want to discuss the difference between standalone and hybrid long-term care insurance solutions. There isn't a one-size-fits-all solution, and you should have both of these on your shelf. Before we get started, though, at the end of this session, we will answer any and all questions you may have regarding long-term care insurance, even if it may be off topic. Simply type in your questions in the chat box of this presentation. So, Larry, let's get started.
All righty. Good morning, Brittany, and good morning, everybody, or good afternoon, depending on what part of the country you are in. I'm in Seattle, so it's still morning here. And as Brittany said, we are going to talk about contrasting traditional versus asset-based plans. And as I preface this whole discussion, understand that honestly, one is not necessarily better than the other, but they have specific planning purposes in mind. So that's the spirit. It's not one versus the other, but contrasting them so you have a sense of when you might apply one solution versus the other. And that's the beauty of working with Jetter, because frankly, they're your consultant in this space and they're your compass, so to speak, in terms of which direction you should take it. So looking at the agenda, it's very straightforward this morning. It'll take about 20 minutes. And we're going to talk about, first of all, just a reminder of the justification behind long-term care planning. I have a few slides to share with you that I think will certainly engage your thinking as to why we do this, as opposed to letting our clients self-fund when there's other opportunities for them. And then we're going to go into the differences between the two planning concepts, right? So starting with the justification, remember, the leverage from these contracts can't be outperformed by the market. You just can't do it. You give us a 50 or 80 or $100,000 or break it up over 10 years, you're not going to outperform the leverage of insurance, even with today's higher rates. The growth, of course, in these contracts grows tax-free. That's beautiful. And also the benefits upon claim are not considered income. They're tax-free. So again, thinking about no planning in place, having to liquidate taxable investments, maybe paying gains, maybe having to do this when the markets are in a mess. This is a great way to, again, protect the portfolio, allow the portfolio to do what it's supposed to do, grow wealth, and minimize the risk to it. That's why we consider this a foundational strategy to every estate planning play, because this is what's going to be the financial glue that holds everything together. Minimizes your need to disrupt assets big time. This becomes the primary source of LTC funding, using that portfolio to supplement maybe the shortfall. But at the bottom line, however you cut it, we're looking at strategies here that are specifically designed to maximize and protect one's legacy while they're alive. So with that, let's just get right into the justification real quick. This is just a quick reminder, and I'm using a scenario that I put together to build the illustration. I'm looking at a 55-year-old married male, 28% tax bracket, going on claim at age 83. And that age is important because that's our average claim age, and it seems to be pretty darn close to the rest of the industry. And what we're looking at is an annual funding amount of $14,223 per year over a 10-year period. In other words, we've got a 55-year-old. This individual is not retired. In fact, his primary goal is to build his retirement. So most people in this position would not be wise to reposition a large asset all at once, unless they certainly have the ability to fund long-term care, but they incrementally fund it out of income. So if you imagine—
Hey, Larry. Oh,
yeah.
Sorry to interrupt, Larry. We're still on the beginning slide.
Oh, really?
We're not seeing your example. Yep.
Oh my gosh. Okay, it's not moving. That's weird. It's moving on my end. Let's come back here and see what's going on.
Here we go. We're getting somewhere. We're now on LTC planning, the justification.
Oh, how strange. Okay, because I've been just flipping along. Thanks for letting me know.
You're welcome.
So can you see that one?
Yes.
All right. Sorry, folks. I just was bounding along here. So back, as I talked about it, we have a pre-retiree. There's his age. But actually, the most important part we're getting to. This individual, if they were to self-fund, can do so one of two ways: very safely or taking risk in the market. Going very safely, with a fixed investment might get you, best case scenario, 1.5% after tax rate of return. That's not going to be enough if you're going to dollar cost average at a rate of $14,243 a year. That's just not going to give you much. So your other alternative is to take risk in the market. Typically, you're looking at a lifetime after tax rate of return on average of maybe 6%. And we're going to contrast that to making that same commitment over 10 years into a product, in this case, MoneyGuard 3. $14,243 a year in premiums to fund a 5-year plan that's going to grow, in this case, 5% compound. And I want to preface that you're probably not used to hearing about 5% compound because it is expensive, but over time, that expense up front well makes up for itself over time. So take a look at, if we did this, what do you have by age 83 when you go on claim? Well, you'll notice that green bar that's circled. That is how much purchasing power you create with the insurance solution. And you'll notice that the blue bar, meaning the safe investment, doesn't get you there. And even taking risk in the market doesn't even get you close. And where the rubber meets the road, just immediately below to the right, you'll see a 1.5% rate of return and a 6% rate of return. These are after-tax rates of return. And I didn't mention at a 28% tax bracket, okay? Playing it safe, you would have left over $856,000 on the table for long-term care purchasing power. If I even took risk in the market, I'm leaving over $652,000 in purchasing power on the table. So that's what we're talking about. And to kind of drive the point home, thinking about the numbers real quick, you'll notice in year one, at age 55, that first premium payment is made of $14,243, which means that translates into day one, tax-free benefits available of $265,244. And if this individual were to unfortunately pass away that year, the death benefit of $104,000 would mean, in a morbid sense, an internal rate of return of over 251% return on your investment. Meanwhile, look to the right. We're just starting either of those accounts off day one with $14,000. Not a good time if you needed long-term care. It'd be devastating. By the end of that premium payment cycle, when we basically paid out about $144,000 in premiums, at that point in time, I will have accumulated over $338,000 tax-free in the insurance vehicle. Taking you all the way to the right, I would only be in the market up to $95,000 after tax. So just a dramatic trade-off in terms of why we do this. And by age 83, it speaks for itself. I'd have over $1 million in tax-free from $144,000 investment compared to only $387,000 in the stock market, right? So taking risk in the market doesn't provide nearly the reward for long-term care planning that a long-term care planning insurance solution would. And I'll add right here before we jump into the guts of the presentation, this is with a higher priced asset-based solution. If we were talking about a traditional long-term care planning solution, that $1 million number would be even bigger because they are less expensive solutions for the leverage you buy, but there's reasons for that. So with that, as I make my transition, Brittany, can you see that slide? Is it following along with me now?
It is.
Bingo. Okay, so now the guts of the presentation, traditional plans and asset-based plans, the similarities and the differences. And again, this is not one versus the other. How are they similar? How are they different? So let's look at the similarities first. Obviously, both strategies comply with IRS code 7702B, which simply means that these accounts grow tax-free and the distributions at the time of claim are also tax-free. So that's real important. As far as care settings, they also all cover basically the same things, from care in the home to care in the facility. Now, I'll put a side note in that care in the home is becoming particularly appealing and invaluable because of COVID-19. I have neighbors of mine that are in their late 60s, early 70s that are saying, thank goodness they don't live in a retirement facility right now. They're so fortunate in their mind that they're in their own home where they can control that COVID risk. That's important. Benefit triggers are the same. The reason they're the same is that they, again, comply with IRS code 7702B. I'm often asked, what constitutes a tax qualified plan? And it comes down to benefit triggers. That's how they define these. 2 of 6 ADLs are cognitive. And in the final assessment, when we're looking at how benefits are triggered, they can be reimbursement on one end or reimbursement and an indemnity on the other end. All right, so that's kind of where the differences are beginning to manifest themselves. As for the difference, here's where we are. Kind of the significant one. We refer to traditional plans as non-can or non-cancelable, guaranteed, renewable. So in a nutshell, that means the rates are not guaranteed. Asset-based solutions, or hybrids is another term you'll hear, they are guaranteed. And that's appealing to a lot of people, especially those who can afford it. They want that bird in the hand, right? When it relates to death benefits, of course, you don't have death benefits with a traditional solution, but you do with asset-based solutions, right? So that's another second appealing notion of the asset-based versus traditional. And of course, there are no cash values in traditional plans. That's pure risk, pure insurance, like your homeowners and your auto and so on. Whereas cash values are a critical component to a asset-based program, which means you have the ability to get a return of premium if you were to surrender the contract. You can, in some cases, get it all back at a pretty steep price. Vast majority of the people don't opt for that. They just are happy getting something back.
And Larry, I actually want to interject for some of those that might be newer to the long-term care solutions. While the standalone policies typically don't have a cash value, P.S., there's one out there, you can add that as a rider, but all of the carriers will have some type of return of premium at death available. Transamerica builds one in, a couple other carriers that is an additional rider. So while we don't have the cash value to make the choice to walk away in most cases, we do have the ability to give a beneficiary something regarding premiums, less claims. So my personal gripe is the traditional or standalone's not a use it or lose it unless you make it that way. It's just simply the fact that you're not going to see that cash value or growth that you may see in those hybrid policies. So that was my 2 cents, Larry. You can continue on.
No, and to build on that, that's a real important thing you brought up, Brittany, because they look at that option and typically agents will sell against it because it costs more money, but it's an important feature. So it's certainly, in a sense, there's an expense there, but if there's an estate planning objective, why not, right? It makes a lot of sense to have access to that. Actually, when it comes to elimination periods, there really is very little difference. There's one carrier that has a 0-day elim, and that's Lincoln. But for the most part, you're finding with traditional plans, you're going to get a little more flexibility in that space, either a calendar day or day of service. For the most part, asset-based plans are days of service, which calendar day tends to be more appealing in its basic structure. As far as the plan structures go, you have both single applications and now, I know with one carrier, essentially a joint application, joint contract available as well. Same for the asset-based side. And finally, for benefit limits, again, some similarities here. You do have specific durations, and for a long time, that's all you had in the traditional space. But now NGL brings a product to the market that gives you access to a flex pay, which is a single pay or 10 pay, very appealing. On the right side, with regard to asset-based products, the unique outlier there is One America with their lifetime benefit. So at a high level, I pretty much gave you all that you really need to worry about knowing. And the nice thing is that you have Jetter backing you up all the way. Art Jetter and Company is a group that can actually help you navigate through the bigger picture in terms of specific plan design, product fit, and suitability. But if you understand the concepts that we shared with you here, you'll have a good understanding in terms of how to deviate from one strategy to the next based on what your clients articulate. The final thing that I'll say is that what matters to your client most is probably where you should start. And oftentimes when we think about the asset-based solution, your client's going to bring to you the typical objections of, Use it or lose it scares me. Lack of premium guarantee scares me. I want a death benefit, a way to recapture some of that lost investment. Well, the good news is you have something to talk about. Now, the question is if it's affordable or not. The nice thing is that you can then pivot back and provide them what they truly can afford. So, Brittany, that's the story for Friday afternoon.
Well, great. And we actually did have some questions that came through, Larry. So sit tight. First one is really about taxation regarding the hybrid policies. And so carriers have different takes on this. And Larry, apologies, Lincoln Financial and their MoneyGuard product does not feel there's tax deductibility within the policy. However, their competitors and some of the other carriers, you will see on their illustration software and quotes that they will break up that premium. Portion of it goes to the life insurance policy, other portion goes into the long-term care benefits. And when they break that premium up, it is under their philosophy that LTC premium value can be potentially tax deductible. I'm not a CPA. That's as far as I get with that. So definitely I would say reach out to your tax advisor or CPA for clarification on that. And of course, each individual states may have different rules regarding the tax deductibility or taxation benefits you could see. So while Lincoln Financial doesn't break down their premium, other carriers do. All right, so a Lincoln specific one has come through. Is the Lincoln age limit still at age 69 due to COVID, or is it back up to age 80? Larry, I'll have you tackle this one.
Sure, that's a great question. We're still up to age 80. In fact, kind of separating ourselves from the marketplace, we decided not to abandon that 70 plus segment, right? Odds are we find that a pretty safe place to navigate, because I don't care what carrier you're talking about, a significant number of those applicants get declined anyway. We see about a 50% declination rate roughly in that age band, 70 to age 80. So our posture is this: if somebody is in exceptionally good health, no underlying conditions, simply taking great care of themselves, we'll underwrite that case. If we're talking about somebody who might be a type 2 diabetic or has other underlying issues along with their existing health that would put them between a table 1 and table 4, between the age of 70 and 80, we won't decline them, but we will postpone that decision until we have a better feel towards the impact of COVID-19. So definitely lean on the folks at Art Jetter in terms of sizing up whether that's a case worth coming our way or not. They'll be able to help you.
Correct. And if you're working with any cases at all, especially older issue ages, feel free to reach out to us. We've seen carriers starting to lift some of those restrictions on being able to take applications. Others have taken that philosophy of 70 is a cutoff. I can't even quote it at that point. But the good news is, on both sides of the coin, I still have options. So make sure to reach out to me if you have anybody in mind. So Larry, I've got another one for you, but I need you to go back to slide 7 where you're showing the MoneyGuard 3 example. If you could do that real quick for me.
Sure.
Perfect.
This
Oh,
one
great. Yep, that last one.
There you go.
Right there. So we've got a producer who's, and I think you can explain this best because I have a paragraph that I actually look at every time I get this question regarding that death benefit. In your example, we are seeing that increase really in the first 15, 16 years, and then we start to see that death benefit come back down. In simple terms, can you explain why?
Sure. First of all, if we had a single premium, the death benefit would be at its peak year 1. So what you're seeing happening in the first 10 years as premium is being added to the contract, you're going to see growth in cash value, which shows growth in the death benefit. After year 10 into year 11, you'll then notice it's steadily declining. And that's because we're using the internal values in the cash value to support the long-term care rider, the internal charges associated with that. Now you'll notice it hits a bottom at 142,430. That means the contract is funded. That is what we would call the initial specified amount. I don't like that terminology, but that's as low as the death benefit will go. But bottom line is this: these contracts are doing two things instead of one two things, meaning they're designed to pay a death benefit, or we're saying you can have the death benefit early and we'll use that for long-term care. So the internal cash values of these contracts are supporting that ability to fund long-term care in the future.
Perfect. Appreciate that, Larry. And one last question, which I'll get to tackle here, is regarding care coordination. And so, yes, most carriers are going to offer some type of care coordination service that comes with the policy. And this service is going to be there to help the policyholder or maybe family members trying to create the care plan of care, and they can be used as a resource. Maybe that's the different types of services available, providing contact information, and then, of course, being able to set up how that claim's going to look between the carrier and the policyholder. Larry, you all have a special program, so I'll give you just a quick moment or two to talk about yours with Silverbrick.
Yeah, and the Silverbrick name has been retired, and we now call it a concierge care coordination service. And bottom line is this: we have a platform, a web-based platform that allows a policyholder to pre-plan prior to the claim, meaning take a step back, ask yourself where you think you're going to retire, whether it's where you are now or where you'd like to be, and then ask yourself the question, who would I bet my life on, and formulate a care circle. And the care circle is composed of family members and friends who literally you trust your life with. So you can set plans in place of who you'd want to engage and what they need to know about your affairs. With this platform, you're able to give them the ability to log in and basically check out how the individual's doing on claim. So once a claim happens, what we've done is brought these two events together, pre-claim and then post-claim. And once the claim has taken place, then your loved ones have a place to log in and monitor your progress, monitor your caregiving activities, and anything else they need to be aware of. Also, most invaluably, you have the ability to upload important documents like a durable medical power of attorney, a trust document. So everybody within your care circle has no excuse but to be on the same page as it relates to your desires around long-term care. The final thing I'll mention is that when you go on claim with Lincoln, two things to keep in mind. You're going to have the same claims representative for the life of your claim. You're not going to be relegated to an 800 number and hope the person you talk to is up to speed on your claim. And also what we're seeing in much greater numbers, and when I'm talking greater numbers, over 90% of the claims filed now, policyholders are asking that those benefits be assigned directly over to the care provider, because that gets them out of the loop of having to administer invoices and receipts and lets us do it for them. So that's a huge plus, and it actually nudges us a little bit closer to the behavior of an indemnity contract.
Perfect. I appreciate that, Larry. And actually, that wraps up all the questions coming in. So with that, I want to thank everyone for joining us today. Also, thank you, Larry, for co-piloting today's session. And both Larry and I are very excited to host the LTCI Sales Bites sessions as we present a new topic each month. We've already got the next one scheduled, and it's coming up Friday, August 28th at noon Central Standard Time. Make sure to mark your calendars and watch for that next invite. However, if you still have questions or would like a one-on-one discussion, please feel free to reach out to our team. That number's 800-228-0008, or simply email us at ltci@jetter.com. So again, thank you, everyone, and enjoy the rest of your day.
Thank you, Brittany. Have a great day, everybody.